If you've heard no tax on tips, you need to hear this carefully because the IRS just released the final regulations, and what most people think this law does is actually wrong. In this video, I'm going to break down exactly what changed, who qualifies, and the biggest mistakes that could cost you money. So in April of 26, the IRS and Treasury finalized the rules for what's being called the no tax on tips law. And these rules define who qualifies, defines what counts as a tip, and locks in how the deduction works. And they apply to tax years starting in 2025, and the final regulations become effective in June of 26. Now let's clear up the biggest myth right away. This is not a tax-free rule, and I hear that all the time. Tips are still included in taxable income. They're still reported on your tax return, and they're still subject to Social Security and Medicare taxes, and that's a big misunderstanding. This is a Section 224 deduction, not an exclusion. So the government did not eliminate tax on tips. They just created a deduction that reduces your taxable income, and this is a big misunderstanding. So here's how it actually works. You can deduct up to $25,000 of qualified, and that's crucial, qualified tips per year, but there are limits, and they begin phasing out at $150,000 if you're single or $300,000 if you're married, and it applies whether you itemize or not. And it's important to understand they're temporary. This is only from 25 to 28. Now let's look at a simple example. Let's say you're a server who makes $40,000 in wages and $20,000 in tips. So that's a total of $60,000 in income. You can deduct the $20,000 in tips and taxable income drops to $40,000. But you still pay payroll tax on the full $60,000, and that's the big difference most people miss. Now, who qualifies? Well, the IRS finalized a list of 70 plus qualifying occupations, and you're going to have to go and look at that list, and I'll put a link down below. But this includes categories like beverage and food service, entertainment and events, hospitality and guest services, home services, personnel services, personal appearance and wellness, recreation and instruction, and transportation and delivery. This includes things like servers and bartenders, hairstylists, taxi and rideshare drivers. It can even include people who are maybe working on your air conditioning at home and you give them a tip. So there's a lot of jobs on here you might not have thought about, so you're gonna wanna look at that list. I actually covered that list last year, and the truth is it didn't change much. So if you listen to that video, you'll get most of what you need right there. But if your job is not on that list, and this is critical, you don't get the deduction. So this is important. What counts as a qualified tip? And this is where things get very specific in the final regulations. To qualify, a tip must be voluntary, and this is huge. It has to be given by the customer, but it has to be voluntary, and we'll talk about more about that in a minute. It has to be paid in cash or cash equivalents, like a credit card, an app, etc. And it has to be received in a qualifying occupation like we just talked about. So let's look at a couple real examples. One, a customer leaves $50 on a credit card tip line. Perfect, that's okay. Uber rider tips through the app. Fantastic. Salon client gives cash directly to the stylist. That's wonderful. They all qualified because they were voluntary and cash basis, and this is very important. Now let's talk about some that don't qualify, and this is a big one. Restaurants that add automatic gratuity, like think the 18% because your group is bigger than 5 people or 6 people or whatever it is. That does not qualify. However, if the person chooses to pay like 25%, the extra 7% qualifies, but the 18 doesn't, and that's where this turns into a nightmare headache. Another example that doesn't qualify, a hotel charges a mandatory service fee. Maybe a customer gives tickets or meals or gifts. These do not qualify under the final rules, and it was very specific. Another example, going back to the restaurant, let's say you have on there the option to choose maybe 5%, 10%, or 15%. If that's how it's set up, none of those tips qualify as not being taxable because there wasn't an option for zero. There has to be an option for zero, and this is a very big deal, and it's been spelled out there. So we can't mess around with this. You've got to make sure your software or however you're tracking this keeps up with this. Now, obviously, there's a lot of room for abuse here, and the IRS was very concerned about it. They specifically included rules to prevent people from reclassifying income as tips, and business owners, mostly I'm talking about you. Because what are you going to say? Oh, well, instead of wages, I'm going to call this compensation tips. That won't work. If it's not true, voluntary customer tip, it doesn't qualify and you can't play games with it. They're prepared for this, so don't try it. Now here's some more real world impact that I'm seeing in real life from the law. So let's just take a look at it. Example 1, server, 18,000 tips. They'll likely get the full deduction and potentially little to no federal income tax on tips, but don't forget the payroll tax side. Example 2, high income worker. Maybe this is a side gig as a bartender, 25,000 in tips, 160,000 in total income. Their deduction could start phasing out and potentially have a reduced benefit, especially at that level if they're single. Example 3, restaurant owner. You now have to clearly track. You got to track tips versus service charges. We have to track voluntary versus mandatory. We talked about this. You can't mess around with this. You got to make sure your software is doing it because like I said, how hard is this going to be if you have a 18% because it's bigger than 6 and they tip 25? You got to keep track of both. So make sure your software is doing it because this can become a compliance nightmare and not just a tax benefit. So make sure you're prepared and don't get surprised by this. And on that same vein, starting in 26, W-2s will include a new field for qualified tips. So this has got to show up directly in payroll systems, and you as the business owner are responsible to track it, and you have to report it on the W-2 this year. You can't get away with it like last year. You have to do it. So as a CPA, here's the real takeaway. This is not a simple tax break. It's a compliance heavy deduction, and if you don't do documentation, it could turn into a nightmare. Documentation is going to matter more than ever. And most importantly, just because you receive tips, that doesn't mean they qualify. I don't care what anybody else is telling you. This law does not eliminate tax on tips. It does change some things and give you some advantages, but it doesn't eliminate it. So I hope you understand this. So if you want help figuring out whether you or your employees qualify, drop us a comment down below or reach out. We can set up an appointment. We'd love to help you. And if you want more breakdowns like this on new IRS rules, hit subscribe because this is exactly the kind of stuff we cover every week. So until next time, see you then.